think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, we are here, Money Level Show and the ROI channel, the return on your investment. How important is that?
That's everything.
Yep. So I got my guy Benjamin here. We actually talked about collaborating more on some stock analysis, so we're happy to bring some new content to you all. How you doing today?
I'm very well, thank you, sir. Pleasure to be invited to your show. I've been a fan for a while, so thank you.
Yeah. This is a mutual beneficiary situation. I love the macro. You love the micro. I'm trying to grow and learn in that, and so I'm happy to just learn from you and everything as well. So for everyone that's watching on my channel, the Money Level Show, be sure to go to the ROI channel. It will be tagged. His channel will be tagged in the description and the title of this video. That way we can drive some traffic to both of our channels. So so today we're going to get into uranium royalty. We're going to get into that in a little bit, but I do want to spend some time just kind of chatting about how are you feeling about the uranium market right now?
It's interesting. It's been one of these stories that I think for 5 or 6 years, the motto has been anytime now, anytime now, anytime now, anytime now. But if you look, I think the big difference has been the amount of volume contracted in the term market, finally. And since the first time since 2012 that we've seen this kind of levels of contracting occur in the term market. So disclosure, I am a uranium bull. I'm not as bullish as some other guys out there, but I certainly am a uranium bull. I do think that these catalysts that people on your show have talked about are really making a difference. Japanese restarts, political changes I see, particularly in the news. Sweden have actually, there's a lot of talk about them changing their stance on nuclear and uranium mining. And I think probably the biggest catalyst has been this bifurcation between the East and the West. The unfortunate circumstance happening in the Ukraine right now has meant that the West, we have really had to wake up to our supply chain issues, and particularly with regards to enriched uranium, which is what's needed to enter into fuel reactors.
Yeah, 'cause I think Russia does what 30? How much? 30% or something like that of enriched uranium.
Yeah, I think it might even be a little higher. But I think the biggest question is what's going to happen moving forwards when if the whole world is more or less being split into two geopolitically. The new supply all seems to be happening in sort of Uzbekistan, Kazakhstan, and obviously those countries are more or less on lock with China and the Russians. I.e., we'll call them East. We're going to the NBA All Stars where you've got the East and the West, and it's kind of like that. So we need to get our act together and figure out where we're going to get these pounds, how we're going to process them, how we're going to enrich them. So I think it's happening.
Yeah, there's currently a bill, which I probably won't share it right now, but there's a bill at the Senate for the U.S. to ban Russian uranium, enriched uranium, and so that's something that's it's like, okay, well, are we ready to ban enriched uranium? That's the key part, but it also points to like, okay, there's going to be some more investment into the space, and there's also a lot of talk about the national security piece of it as well. I mean, obviously the military uses nuclear significantly as well, so that piece of it as well is something that could be a catalyst for this bull market.
Oh, most certainly. I think that the North American uranium plays will be huge beneficiaries of that. I guess around the world, all nation states tend to have these kind of protectionist policies, and if you're uranium explorer, developer, producer, friendly to the, let's call it Team West, I think this has been a wonderful thing. In addition to the coup in Niger, which has kind of put question marks over where 5% of the world's uranium supplies is going to go into the future. So the market that was already tight is looking more and more tight as we go.
Yep, that's good. That's good, man. So yeah, let's go ahead and hop into this stock analysis. We put this together, so you all sit back and enjoy. Um, and yeah, let's get it. All right, so let me go. Hello, everyone. Sorry for the break in action, but I want to tell you about the link in my description below. This is to the New Orleans Investment Conference. This conference has been around for years and have brought many people out, such as Milton Friedman, Gerald Ford, Alan Greenspan, and Margaret Thatcher. This conference is put on by Brian Lundeen and his team. Brian is the CEO of Gold Newsletter. This year, they're going to have speakers such as Jim Rickards, George Gammon, Peter Schiff, Rick Rule, Danielle DiMartino Booth, Lynn Alden, and many others. Now, I encourage you to click the link in the description below. You can choose to attend the live event, which I will likely be at, as well as the event that is live streamed. You can support the channel by using my link below, so I encourage you to check that out. Now, let's get back to the interview. So, slideshow. Boom. All right, so we're looking at Uranium Royalty Corp. So for those of you that don't know what uranium, what royalty and streaming is, royalty is when a company finances a mine or something of that nature, and they receive a percentage of the income from that company. And then streaming is where they get the whatever is mined at a discount. Is that correct?
Yeah, that just about sums it.
I kept asking people that at the symposium. I'm like, did I get it right? Did I understand it? All right. So Uranium Royalty is a royalty corp for uranium. All right, so this I'm up on the plate right now. So I just pulled up some information regarding global warming. Some people may not believe in the narrative of global warming, but nonetheless, politicians are moving based off this narrative, and they are wanting to reduce carbon emissions. And so, as we can see, it shows a chart from the 1880s to now 2020, which shows that the temperature of the Earth is increasing. Some highlights on the side. It says that the Earth's temperature has risen by an average of 0.14 Fahrenheit per decade since 1880, or about 2 degrees Fahrenheit in total. One thing to really note about this is that as you know, in the last 200 years, we have industrialized a lot. We went from riding horses to trains. You know, we went from freaking farming, you know, with our blood, sweat, and tears to like using tractors. So there was a lot of energy that was being used in these new methods of industrializing, and so they tracked this from 1880 till now. All right, so next, this is a chart from NASA that shows the ocean temperature, and so it shows that the ocean temperature has been on a steady incline for a number of decades. Here we're looking at the world population. The world population continues to grow significantly. I mean, as we can see in the last century, we've increased by 8 billion people, 7 billion people. And so it was interesting because at the Rural Symposium, Robert Friedland was speaking. He owns Ivanhoe Mines, and he talked about in the 35 years he's known Rick Rule, the population grew 2.3 billion. And so as the population continues to grow, energy needs to become more abundant. And if the climate change narrative and the carbon goals that countries have, you know, they're going to have to step up. And I believe nuclear is a part of that revolution. And so as a base load power. Anything to add on that?
There's a great about 1 hour video that Go Rosen from Goering and Rosenzweig is a research and hedge fund in New York have a wonderful sort of 60-minute video presentation on the history of population growth. Now, if you note the graph that Daryl has here, it's flat, flat, flat for centuries, for millennia. So, what was the catalyst that allowed that population to explode by orders of magnitude in just call it 200 years? And it was this progression from energy sources, from those with a low energy return on investment to those of a high energy return on investment. So, for every unit burnt from, say, cow dung and wood, which is what we used up until around that 1800s. That little blip just before the 1800s was the discovery of lignite coal being used as a fuel source. And so it had let's say a 30 or 30 to 1 return on investment. And then we found natural gas and oil and then nuclear, which is, depending on who you listen to, maybe 100 to 1 energy unit return on investment. So it's very interesting that high density energy fuels have been what have allowed us to grow as a population. And as we grow as a population, obviously there are more people that use more energy, and it's all happening in the emerging markets at the moment. So where the growth in population is around the world is emerging markets. And not only do we have more people, each of those people are going to use more and more energy as they start to improve their living standards.
Yeah,
And so exactly what Daryl said, nuclear has to be a part of that due to A, its return on investment, and B, the fact that it's a zero carbon fuel source.
yep, yep, exactly, exactly. That was wonderfully spoken. Now, demand. Now we get to demand. All right. So the International Energy Agency put out this chart in their Outlook in 2022, and it shows that energy demand, the future estimates. I mean, as you can see, from 1990 to 2000 to 2021. So over this 30-year period, I mean, it almost tripled. And then we're looking at by 2050, um, nearly doubling from there. And so the demand looks like it's going to get even more critical in this situation. So then we have our race to net zero. These are many nations within the world that are racing to. It's almost like the space race. That's what it kind of reminds me of. And so, but they're racing to decarbonize, and so as you can see, most of them have 2050. I feel like that was just a benchmark number. It was just too many of them had 2050. It's like I think you just took it from one person and then just kept using it, like or something. Uh, and then China has 2060, which China obviously has billions of people, over a billion people in their country. So um yeah, I mean, and the interesting thing is, like, even with this, I was listening to Robert Friedland speak. It was just amazing. But he was talking about he talks to all the major miners, the major producers, Rio Tinto, BHP, and he asked them, like, hey, where are they going to get these materials from?
Yeah,
And they have no answer. And so when you have the biggest minds and producers in the world doesn't really have an answer for all of these carbon neutral goals, that means that we're going to have a squeeze or a supply demand shock at some point.
I tend to agree.
Nuclear reactors. We have China's obviously building the most nuclear reactors right now. India, Africa, and the Middle East, and Asia, and so the West is still down here quite a bit. We got ways to catch up.
We do a lot of plant extensions, though. I see, like Diablo Canyon over in California. So I think that's kind of telling the story without the politicians admitting that they're wrong on the stance of nuclear. Is that what was due to be wound up a lot of those plants have been, I guess, I don't know if recommission is the right word, but they've had their plant life extended because there's no way we could get rid of the baseload sources of power right now without
Yeah.
plunging us into the darkness, essentially.
Yeah. And just thinking of like the power grids here in the United States and everything, like we have a long way to go. And I mean, just look at how far China is. Like, I mean, it's how much percentage. I need to get the actual numbers, but just just looking at how far they ahead. I mean, especially India, and I mean, they're putting in work, man. They're trying to get their people. They're trying to get energy security, and they're trying to get people online. So, yeah,
And good for them. Yeah, they're doing the right thing by their population. I believe. Don't quote me on this, but it's. I have spoken about this with Justin Hoon, and I believe the plan is to get 153 reactors by over the next decade in China. So that is an enormous amount of demand for nuclear fuel.
yeah. Agreed. So recently in the United States, we did pass the Advance Act, which is the Accelerating Deployment of Versatile Advanced Nuclear for Clean Energy Act. And this would boost development and deployment of new nuclear technologies, incentivize expansion in America, retool and support the NRC, and which is the Nuclear Regulatory Committee, I think, and help position the U.S. as the world's leader in nuclear energy. We got a long way to go, but I mean, it's an ambitious goal, right? Uh, and so the time is right to make strategic investments in new generation of nuclear energy technology that will lower emissions and head off threats to our national and energy security. All right, so now we're going to jump into the company, Uranium Royalty Corp, which is led by Scott Melby. I had a good time with Scott Melby down at the Royal Symposium. He came onto the channel, and I actually just saw him. Well, not saw him in person, but I was on the Q&A from the symposium, and he was there, so I was able to get some more updated information from him. But so he's been with the company since 2017. I think he became the CEO in 2019. 39 years experience in the uranium sector. He's been the vice president of Uranium Energy Corp since 2014. Was formerly the vice president of the commercial at the Uranium Participation Corp, which is now the Sprott Physical Uranium Trust. And he was the former advisor to the chairman of Kazatomprom. Serves as the president of the Uranium Producers of America, and he has testified in front of Congress about the need for nuclear energy, and that was earlier this year. All right, I'm gonna go ahead and take it away, Ben.
All right, guys. So
Just let me know when
when we
you want me to click the screen as a slide too.
yes, sir. Okay, so we're talking about uranium, and Daryl did a wonderful job giving us a macro and meso backdrop. One thing that is ideal is to see if you can come up with a business model that can gain upside in terms of revenues without a commensurate increase in expenses. And that's the royalty and streaming model as traditionally known. So this company, Uranium Royalty Co., its long-term strategy is to gain exposure to increasing uranium prices, which we certainly believe are going to go higher to reach those goals that Daryl mentioned in his presentation. And so this company manages a portfolio of geographically diverse uranium interests. Some of those are already producing, some of those are mines to be developed, and some of those are exploratory companies. In executing the strategy, the company seeks interests that provide direct exposure to those prices without the direct operating costs. In other words, your gross should be your net, as Rick Rule likes to say. So you have your fixed expenses, and then you have an upside to increasing revenue, and the difference between which, in theory, should be an expanding profit margin over time. So the pros of this, it's just a beautiful, beautiful model. Warren Buffett has invested in these types of businesses, such as Visa would be a great example of some of his investments in this space. For the same reason, you get protection from inflation due to the fact that your expenses normally are fixed and upfront, and you enjoy an increasing claim on those revenues over time. Now, I've put in brackets in theory because there are a few little caveats to that I'll explain in the presentation. So if we're interested in the uranium sector, ideally, we would like to get access to the royalties and streaming companies. The good news is that the choice is quite easy because there is only one company, and that is Uranium Royalty Co. Whereas in the gold sector, for instance, you have your Franco-Nevadas that were the original royalty and streaming company, Wheaton Precious, Sandstorm, Cisco, so on and so forth. Now, what are the cons to this type of business when it comes to a return on investment perspective? The fact is that everyone knows how good these business models are, and normally it's hard to buy them at a cheap valuation. These companies attract and arguably deserve a market premium. When it comes to this particular company, I guess the development and exploration risks would also be a con in terms of, okay, we think we've got a certain amount of interest, but what happens if there's a delay or there are problems getting a mine from exploration to development into production? And there are a million and one things that can go wrong in that evolution. Probably a good time to move to the next slide, sir. Okay, so when it comes to valuation, there are a few different metrics that you can use. If you have an already a company that's already producing income or cash, we can use a discounted cash flow model. But what do we do in this situation? This is a company that is really relying on future claims on developing assets that aren't already producing cash. So the way to look at this normally is to look at the amount of reserves that the company has access to, work out using a price matrix what we think the uranium price is going to be and how much uranium these particular companies have. And then from there, discount that back to a present value in today. If that sounds inexact, it's because it is, okay? You're taking geological reports and you're making your best estimate as to how much resource or reserves a particular company has and what the price of those reserves are expected to be. All I can do here is use what's in the corporate presentation. Uranium Royalty Corp is saying that at a price of $223, that would suggest the company is trading at roughly half its net present value. So if I do some inverse math there, this model suggests that the net present value of the resources to which this company has access is around $4.21. All right, next slide, please, sir. Okay, now, if we're looking here, there are a few things I wanted to point out. This FD, 118 shares on issue, that looks different to the current shares outstanding. Why is that? Because companies have warrants and they have options and all sorts of things as part of either capital raising and or management compensation. And so when you're looking forward to a company that will be valued in what they're doing in the future, you need to take that into account, or else you can be in for a very rude shock. In this case, there's about an 18% dilution already on the current float. Next slide, please, sir. So I just thought that was important to point out, as all my valuations will be based on that. Alrighty, now it's a little hard to see from where I am, but what I have learned, particularly over the last 12 to 24 months, is management really matters. So obviously Scott knows what he's doing. He's been in the industry for a very long time. What I'm looking for personally is more around the incentives of the management. So the management can be very competent, but where are their incentives? How much of the company do management own? And how did they get that? Did they write themselves their own stock options, or did they actually reach into their own pockets and buy shares in the company? So here you can see UEC.
All right, so my bad. I don't know what happened to the names, but this is Scott Eric Melby here in the bottom left corner, and then I believe this is Sprott Management here, and then this is Amir, and then I forgot the names of these, but these shows.
So I know.
Yeah,
That's okay. I think it might just be the Canva formatting. In any case, people can look this up. It's public record. It's not it's not not classified information,
Yeah.
but the highest percentage ownership is in UEC, so as a company, and that's okay. I prefer to really look on an individual level. That tells me, okay, how much do these guys really believe in the company? So Scott has $1 million worth, Amir has 5.1 million. As a percentage of the shares, those guys own, let's round it up to say 3% of the entire company. And then Sprott management, that's key. Why is that key? Because Sprott, uh, let's say the legends of natural resource financing. So if Sprott are interested, I'm interested. All right, so next slide.
And I think Scott actually, I mean, he told me like he would just, I think he pulled in his pocket to buy those shares, and so I think that's
Most, yeah, but those individual shares are likely ones that he bought himself, and then obviously with him being part of UEC, he'd also he'd also have a beneficial interest from that 15%
mhm.
ownership. Okay, doke. So there's a great interview in the Rule Classroom where Rick talks about royalty and streaming companies, and he references Franco Nevada as being the best in class, which they are. In the interview, he talks about the management expenses as a percentage of the company's revenues being 12 basis points, okay, or 0.12 of a percentage point. So the question is, all right, well, these guys are putting together a band that's going to do royalty and streaming. Wonderful. How efficient are these guys? How much do they pay themselves? Let's take a look. So currently, here are the revenues from the company, and I know it's a small company, so we need to take that into consideration. If you look at selling and general administrative expenses as a percentage of the revenue, it's about a quarter. Okay, now that is extremely high. And I understand it's a small company, and as I view it, it's basically a startup company. It's a venture capital investment, and they have spent an awful lot of money on marketing, and I guess that's justifiable at the beginning stages of their venture. But it's always good to keep in mind, okay, where do these guys sit in comparison to the best in class? And I know Franco Nevada are a much, much, much bigger company, but it's something I thought I would point out. I would want to see this going down as a percentage over time. If management are paying themselves, I know it includes marketing, but if they're paying themselves and marketing 25% of the revenues, then this is more of a lifestyle company. And I have some bad experiences in the past where everything looked really good. They'd raised a lot of cash, and the management basically just wrote checks to themselves with shareholder money. So I'm not necessarily suggesting this is the case. I'm just saying, okay, look, it's a small company. It hasn't really got going with its revenue. It needs to spend a lot on marketing. That's all well and good. That's all fine. But I would keep an eye on this over time.
Yeah. So you're talking about the selling, general, and administrative expenses. This line right here,
Indeed.
right?
Indeed.
So this needs to decrease from 3.47. That's what you're saying.
I would say either one or two things. In an ideal world, revenues go up and that number goes down.
Yeah.
Because remember, this is a royalty and streaming company. All their work is upfront, cutting checks and doing deals. After that, they don't have any expenses in the operation of these mines. That's the beauty of the model. They do not need to have a large employee count. So all they really are, renting an office space, a little bit of marketing, and after that, you shouldn't see too many expenses.
Yeah.
Um,
Yes.
you
They're
know,
deploying the capital. They're more deploying
correct.
capital versus like operating a mine where you got to have thousands of staff and yeah. So yes, a lot different. All right. Oh, what the heck?
Okay,
That say I don't even know what this. All right, so this is common equity and common stock and such.
no stress. I've got it. I've got it under control, even though it's been kind of format changed. So you've got in this graph that I'm referencing total common equity, tangible book value, common stock, and the issuance of common stock. Don't worry, I'm going to go through it all. So in the gray line here is the total common equity. That's the number of. It's helpful to think of that as the number of shares outstanding on the balance sheet. There are a few nuances there. the tangible book value, and the common stock. The point of this, it really is, we would like to see that green bar going up in value without the gray and the orange bar going up at the same rate. Okay. What that means is the company will be able to increase its assets without diluting the equity base. That's what we
Hmm.
should see. And at the moment, it seems to just be okay, yes, the green bar is growing, but if you look at the gray and the orange, they're also growing a lot too. Now, initially, a company may need to do that in order to really expand their asset base. They may be going through their growth phase. And then the strategic plan might be then, okay, we've hit our numbers. We do not need to spend any more in growth capex. We can ease off in terms of issuing or growing the equity base and issuing the common stock. And in fact, when the revenues and the profits start coming in, they can buy back their own stock, therefore reducing the equity base. And then you'd have this green bar growing and the orange and gray bar actually shrinking over time. So that's what we want to. That's what we want to see, and perhaps it'd be a good question to ask Scott when we get the chance to interview him.
Yep, yep, for sure.
Okie doke. So this is it takes a bit of imagination to value something like this because it's not necessarily a well-established business. So what can we use as a bedrock? What do we really know tangibly about this company? Well, what they've done, they have acquired some physical uranium, so that's worth something, and they've got some cash that's worth something, and they've got some royalties that's worth something. So this has been taken from the 10Q filings on their balance sheet. What I've done is start off with, okay, how much uranium do they have? And I've used an $80 uranium price. Why have I used an $80 uranium price? Because this party that we've all got tickets to, it's not going to start at $60 uranium. It needs $80 uranium to get cracking. So
Yep.
that 85 million in inventory line there, that's valued at the current price. Okay, so I've actually gone up and said, okay, here's the amount of pounds times $80 per pound, and we get roughly $123.4 million worth. Okay, divide that by the fully diluted share count. There's about $1.05 per share worth of physical uranium backing this stock. So that's nice. If we just take the company's word at its present value in royalties, there's around 39 cents per share of value there. So that's my starting base. Anything you want to add to that?
So what you're saying is that it holds 1,548 pounds, and you have to times that by $80 a pound, correct?
That's what I've done.
Yeah,
So
to get the
they own at the moment,
20.
they report that they own 1.5 billion pounds.
Mm-hmm.
And so what do we think that's worth at the current, or at the time of reporting? It was around, I don't know, $58. And that's why they've listed it or accounted it there at $85 million worth. But you and I have an opinion about the uranium price, and we think it needs to be, well, really at least $80 to get this thing up and running. So that's why I've used that.
Mm-hmm. Gotcha. And so, whenever you multiply that, and then you mentioned the $1.05 per share, fully diluted. I want to kind of talk to the audience a little. Could you share a little bit more about the issue with valuation and price? I mean, because obviously, this stock was at like what, $5, over $5 in the last 2 years, and it wasn't valued at that, right, at that point.
Yeah. Okay. So that's actually a very good question. So this people and the stock market in general tend to take their cues from price, and the price is just a quote. It's just an auction bid. It tells us absolutely nothing about what the company holds, what cash they can generate. It's just a number. Okay. So here we're trying to establish a valuation. And then once we've got an idea what we think the company is worth, then we compare it to the price. And quite obviously, if the price is a long way lower than what we think the value is, we'd be interested in buying. And as you mentioned, in the past, the price has been way above whatever I could justify as a valuation. So we would tend to sit on the sidelines and go fishing while we wait.
Yep. 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 Exactly. Or you can sell. I know Rick did some selling in the in the last couple of years when he saw the price move ahead of itself compared to
Yeah,
what he valued them at.
and that's why he is who he is.
Yep. All right.
Okay. Now, again, when it comes to numbers and valuing, some people use these super precise models. Here's something that I have learned and that I live by. That I first heard Ray Dalio say, which is it's better to be roughly right than precisely wrong. So if I can't explain something on one slide, or BOE here on this slide, that stands for back of the envelope. Don't give me these big precise models that go out 20 or 30 years. They're just going to be wrong. Give me something today that fits on the back of an envelope. So what I've done here is I've looked at another way of valuing it and said, what are the expected earnings and what's the expected EBITDA of this company? And what would a company of this caliber normally sell for? So how much per dollar of earnings would this company normally justify in let's say a normal market, not a bull market, not a bear market, a normal market? So EBITDA/S, that's earnings before interest, tax, depreciation, amortization per share. Okay, you don't need to remember that. What you need to know is that this is a crude metric where you have revenues minus a couple of very light expenses, and then I've divided it by the share count. Okay, this is not a great metric to use generally because it's very high up on the expense sheet. There are a lot of other expenses that need to be accounted for, but it is a commonly used valuation metric. Earnings per share, again, it's further down the balance sheet, so it takes into account more non-cash expenses, and then we apply a multiple. Earnings, again, is not my favorite metric, but it is a favorite metric used by the market. So it's handy to get a relative valuation. So these are the numbers divided by the share count, and then the multiple is what is normally expected that you would pay for this type of high quality business model. So if you have a very poor business model, a capital intensive miner, let's say, you might have in a normal market a 4 times EBITDA. You might have an 8 times earnings per share. This is a company with claims on large reserves, with huge expected profit margins in the 80s and 90%. So the market historically will pay a 15 times EBITDA and 25 times earnings. If you compare this to the best in class, so Franco-Nevada, you might expect to pay almost double that EBITDA multiple. You might pay 30 times EBITDA and even 30 times EPS, depending on the market.
Hmm. Gotcha.
So that's, yeah. So there's a very simple multiplication to get an implied price. Okay, so that's
So
using.
are these over here the where well, when you use the EBITDA model,
Mhm.
um, it would suggest that this would be the share price, um, where it should be
No,
valued at. Is that correct?
I've broken this down into two parts. The
Okay.
EBITDA is a claim on future, so it's a little murky. The implied, the third column there with the implied price, is purely the expected operations of the business and what they're worth as of 2024.
Okay. Gotcha.
But remember that this company has cash and it has uranium, which is worth something. And we valued that in the previous slide.
Yeah.
So if you look at what it already owns and what that valuation is expected to be, plus what it's expected to earn next year, then you get a total implied price, in this case of 219. And then if you use the earnings model, 344, because they're different ways of valuing if you're wondering why there's a discrepancy. So then I simply equally weight the two and I just get an average. And in this case, the average expected price using these numbers is $2.82. That would be the value. So then I say, okay, well, what's the price? And you made mention that there's a key difference between the two. And then, and only then, do I look at the market and say, what is the market offering this business to me? At what price?
Mm-hmm.
And did this, I think it was yesterday, August 26th. The company was quoted at $2.39. So there was a bid saying, hey, you can buy this company for $2.39 per share. And I look at it and say, well, I think there's a $2.82 value on this company. That would imply roughly a 15% upside.
Yeah.
So then it's up to the investor to say, well, do I think that's worth it? Or do I think that, no, I want a larger discrepancy between price and value, a larger margin of safety, Warren Buffett would call it. And obviously that's an individual decision.
Yep. Agreed. All right, risks.
Risks. So something I've been guilty of in the past is just using these kind of quantitative models and say, oh, these numbers look so good, I'm going to jump in and buy it, without really thinking about what could go wrong. So what can go wrong with a company? You mentioned dilution risk, and we've seen this in the balance sheet of the company. We've seen them expand their equity base. We've seen them issue more stock. It's not necessarily a bad thing, but it's not really what I want long term at the end of the day. So the dilution risk, the company has, I believe, a $40 million ATM facility. That stands for at the market facility. They can sell their shares at certain prices to raise capital. The issue with that is you dilute your share base. So remember, every unit of profit the company's going to make is diluted by the number of shares outstanding. And so if you imagine the denominator growing, say 1 over 1 is 1, but 1 over 100 is now 1% of what it used to be. And I find it helpful to think of it that way. If the company really just keeps diluting and diluting and diluting, if the only way to get a good return on investment, that company has to grow an enormous amount to justify it. And so it's something that is a red flag that I look for. It can be done intelligently. And so there are two ways it can be done intelligently. When the company is trading way above its value, it's a good idea to sell or issue shares at an expensive price and then take that money. And this is the second way, to perform intelligent acquisitions. One company in Canada that does a very good job of this is Journey Energy. Disclaimer, I own the stock, it's not a recommendation. But if you look at Alex Verge and what he's been able to do, he's been able to issue shares at a certain price and then go and do transactions that increase, that are accretive transactions to the earnings power. Anyway, discovery development risk, that one is fairly straightforward. The company has diversified, I believe, over 18 different jurisdictions, and so that's good. But we're talking about developing mines here, guys. There are so many things that can go wrong. Maybe they start building the mine and they realize, oh, we don't have as much as we thought we did, or we thought it was going to cost X amount to build the mine, and it just takes longer and it takes more time and more budget than what we thought. All these things can happen. SG&A, it's a question mark. I mean, the potential risk with something like this is that the management keep issuing shares, and then they keep writing themselves checks at 25% of revenues. I don't know that that's going to happen. It's just something to keep an eye on, which we mentioned. Question mark here again over the low percentage of management ownership. So Scott owns less than 0.5% of the company in his personal name. Amir owns a little more. I think it was 2.4% in his personal name. I would like to see that a lot higher. If you compare it to another company that I really like, for instance, New Fortress Energy, the CEO actually owns about, I believe, more than 20% of the entire float. So that's really good. But it could just be the case that these guys have other ideas in terms of how they're going to manage the company. Anything you want to add on the risk basis?
Oh, that was good. That's a question I have for Scott too. And yeah, because it's definitely want to own quite a bit of the company, but I don't. I have to kind of see like if 'cause they're doing it in their personal name, so I know some people do it under these LLCs or these other companies and such, and so I just kind of wonder a little more about that.
Okie doke. So moving on to, and this is purely the price side of the equation. So what I've done here is to look over the last 5 years, what's happened to the price of this company. As you can see, late 2021, the price went through the roof. We had all sorts of excitement in the uranium space. Um, the company has retraced over 50% since then, so it's trading about half of where it used to be. And I think that's, as we now know, having gone through that valuation, it's reflecting more accurately the current valuation of the company. Obviously, like $6, $5.50 is a long way north of where we think the valuation would be. And now, for the technical guys in the room, which I am not, I do not belong to that group, but this blue line that you see tracing is a 200-day moving average. Why that's important is when you have a breakout in price above that line, the algorithms in the computer trading models in Wall Street and wherever else get a signal to buy. These computers don't really think; they just get certain triggers and then they buy. So it's interesting to keep an eye on, and we'll see. The company had a little surge on Friday before the close. So whether that triggers more algorithmic buying remains to be seen, but it could be bullish for current shareholders.
Yep. Yeah. There's a and these each one of these bars. So like if you're watching on either of our channels, these are the 1 week bars, correct? So each bar represents a week.
Yep.
Yep. So these are the 1 week bars. So uh, just for those who are not into the charts or whatnot, I know of some of y'all on my channel want to make sure that we can kind of explain as much as possible.
Fair enough. Okie doke. So here, what I've done is plot other things on the same time frame. Okay, so we're looking at a royalty company. What else is in this space? How does it compare to the rest? So how does it compare to the physical commodity which it supposedly sells, i.e., uranium? And why would we buy this as opposed to, or how has this performed compared to the whole sector? So you've got the URNM ETF, which is the basket of the sector, including spot and yellow cake that hold just physical uranium. UROY, I believe, also forms a part of that index, and all the miners from the developers all the way down to the juniors. And then that UXQ 2023 is a quote on the uranium futures. Uranium's a bit tricky because this is the spot market which it's quoting, whereas most of the important stuff happens in the term market.
Mm-hmm.
But anyway, it gives us a quick overview. And as we've seen, the highest performer has actually been the broad sector itself. So a mix of the miners and the physical and the royalty codes. And interestingly, very interestingly, so far the physical uranium has slightly outperformed this particular company. And it shouldn't be the case. Otherwise, why would you buy the company when you can just buy what the company sells?
Yeah. And for those that don't know, the term market is the contract market where people lock in contracts for a longer term period versus the spot market is like the daily price that you can buy and take something in possession. Obviously, we're not going to take physical uranium in possession, but just wanted to give you all that information.
Yeah, it's not recommended. All right, and here we are again, just on a smaller time frame. Okay, so if we look over the past year, the same thing. We're looking at what's happened with the physical commodity versus the producers slash developers of the commodity, and the royalty company. In this case, in this particular time frame, UROY has actually been the worst performer. But again, it's a small snapshot in time. It's not necessarily the be all and end all. In fact, some people may look at this and argue that it's more favorable. If you're looking to buy, you'd be looking for what has not increased in price as opposed to what has.
Yeah, that's good. I think this is the last slide. Yep, it is. All right. All right. That was pretty thorough, man. 50 minutes. We're on. Yeah, that was pretty thorough.
We'll get it down to
I know you usually do them in what, 15, 20 minutes?
Yes, but I absolutely fly through them on my channel. So it's good to have a little bit more time to go back and forth and discuss things with yourself, because sometimes I just talk as opposed to really get engaging with someone else,
Yeah.
and that's where
Well,
the
you're
value is.
doing them by yourself too, so it's you're just trying to get through the content, versus like we're now it's two people on here, so yeah. Well, looking forward to the next company. What's your take on UROY? What kind of questions do you think you have for Scott?
Okay, so if it wasn't clear, I probably sounded a little bit bearish. I love the business model, obviously. I love the story. I love the fact that there is only one option through which you can play this. So it sounds like a match made in heaven. You've got uranium story, which I love, and you got the royalty story, which I love. I just need to iron out a few of these details. So one of the questions will certainly, um, when do you plan to reduce the issuance of stock? What's your shareholder return plan long term? Are you going to be dividend based? Are you going to buy back the stock? Um, how do you see this company's opportunities in a rising cost of capital? I think that's a real benefit for the company. These developers are going to struggle to go to the bank because we've seen interest rates rise. I know you've talked a lot about that on your channel, and I think that's a very interesting point, because these companies will need a lot of capital, and they'll have to start looking to the royalty companies in order to cut some kind of financing deal.
Yeah.
So I'm sure Uncle Rick is going to be busy over the next 5 to 10 years cutting some checks.
Yeah. Agreed. And then if anyone in the audience, who watched this today, if you have any questions for Scott, be sure to drop them in the comment section on either one of our channels, so that we can be sure to bring those up when we interview Scott. And so, well, yeah, thank you all for watching today. Appreciate you, Benjamin, for coming on. Looking forward to the next interview that we have coming up, and then the next stock analysis.
Take care, guys.
All right.